the nuclear option, that is, selling US Treasuries, US bonds basically. According to many, it's the most powerful weapon in China's arsenal.
The global financial community was rocked by a seismic shift in sovereign holdings when, in the wake of a sweeping trade policy announcement by the newly elected US President Donald Trump, China moved to reduce its holdings of US Treasury securities by a staggering $113 billion. The decision, executed over a matter of days, marked one of the most abrupt and significant shifts in China's investment posture toward US debt ever recorded. That such a decisive action coincided so closely with the president's threat of imposing broad tariffs on major trading partners lent an air of calculated retaliation to Beijing's maneuver, underlining the intertwining of geopolitics and global capital flows in the modern era. Before we start, hit the like and subscribe buttons for more exclusive news. At the heart of this dramatic sell-off lay President Trump's announcement that steel, aluminum, and a wide array of goods from key U.S. allies would be subject to tariffs as high as 25%. His rhetoric, framing these measures as a necessary course correction after decades of unfavorable trade terms, was met with swift responses from around the world. Major U.S. trading partners, long accustomed to the relative stability of the global trading system, vowed to retaliate. China, in particular, had signaled its displeasure in private diplomatic channels. Yet it was the decision to unleash such a large block of U.S. treasuries onto the market that truly signaled Beijing's willingness to employ financial leverage alongside more conventional trade countermeasures. This move upended long-standing assumptions about the role of China as a steady buyer of U.S. debt. For years, the nation had been the second-largest foreign holder of treasury securities, a status that underscored the mutually reinforcing relationship between the two economies. American borrowing needs were met in part by Chinese purchases, keeping U.S. interest rates lower than they would otherwise be. Chinese savings, in turn, found a secure home in what was widely regarded as the safest sovereign debt instrument in the world. By abruptly liquidating $113 billion of those holdings, China shattered the notion of its treasury purchases as passive, depoliticized transactions. The immediate financial reverberations were swift. Yields on benchmark 10-year Treasury notes spiked as the market digested a sudden influx of supply. Bond dealers scrambled to recalibrate their models, confronted with uncertainty about whether this was a one-time event or the beginning of a broader, sustained decoupling. Investment banks revised their outlooks, warning that if China's actions presaged a new era of politicized debt trading, the days of rock-bottom yields funded by ever-reliable buyers might be numbered. For the Federal Reserve, the sell-off posed an unexpected challenge. Already navigating the complex terrain of post-crisis monetary policy normalization, Fed officials faced the prospect of more volatile capital flows and interest rate swings triggered not by domestic fundamentals but by geopolitical tit-for-tat. Beyond financial markets, the broader implications of China's decision permeated the strategic dialogue between Washington and Beijing. In economic terms, the move weakened one of the cornerstone arguments that the United States had often deployed in trade negotiations: the alleged interdependence that would deter China from punitive action for fear of destabilizing the U.S. financial system. The logic went that China, heavily invested in treasuries, would think twice before upending the market, and by extension, its own fortunes. By demonstrating a willingness to absorb short-term losses for the sake of sending a political signal, China redefined the calculus of deterrence in Sino-American economic relations. At the same time, the sell-off underscored how deeply enmeshed financial policy had become in the toolkit of statecraft. Tariffs were no longer the sole weapon of choice. The strategic disposition of sovereign reserves could now serve as a parallel means of leverage. In Beijing's calculus, the depreciation of Treasury bond prices and the increase in U.S. borrowing costs were a counterweight to the tariffs proposed by the Trump administration. For a rising power accustomed to wielding influence through trade and investment, the adept use of financial channels represented a natural extension of its diplomatic arsenal. On the geopolitical stage, allies of the United States viewed the drama with a mix of consternation and guarded interest. Countries such as Japan and the European Union had watched the U.S.-China financial nexus with growing unease, aware that strains in the bilateral relationship could ripple through their own economies. Some feared that if China could, even only temporarily, disrupt the Treasury market, then any nation with sizable U.S. debt holdings might contemplate similar tactics in future tit-for-tat disputes. Central banks around the world began quietly reassessing the wisdom of their own Treasury allocations, examining diversification strategies that once would have been deemed unnecessary given the dollar's hegemony. Yet not all observers saw China's sell-off purely as a demonstration of hard power. Some suggested it was, in part, a carefully choreographed gesture to signal Beijing's readiness to defend its interests, coupled with an implicit offer to explore diplomatic resolution. After all, the speed and scale of the Treasury liquidation sent tremors globally, but the market's core remained intact. Prices stabilized after the initial shock as other investors stepped in to pick up the newly available bonds at slightly discounted rates. This replenishment underscored the depth and liquidity of the Treasury market, suggesting that while China's actions were dramatic, the ultimate fallout might be limited if cooler heads prevailed. Nevertheless, the psychological impact lingered. For U.S. policymakers, the episode raised uncomfortable questions about the vulnerabilities inherent in relying on foreign governments as large-scale financiers. Calls emerged for accelerated efforts to widen the investor base for U.S. debt through initiatives aimed at boosting domestic savings and pension fund participation. Proposals to issue longer-dated securities to match Chinese reserve management horizons gained traction, as did suggestions to more actively market treasuries in markets like India and Southeast Asia. In Congress, the sell-off invigorated debates over the national debt and the imperative of reducing fiscal deficits to make the United States less beholden to external financiers. From a strategic standpoint, China's action arguably marked a turning point in how major economies might wield financial instruments in geopolitical contests. Whereas the Cold War had seen ideological competition manifest in proxy wars and space races, the 21st century promised contests defined by complex interdependencies and intricate financial linkages. The liquidation of treasuries served as a vivid reminder that economic instruments, whether tariffs, sanctions, or reserve adjustments, had become powerful tools in the pursuit of national objectives. Analysts also pointed to the broader context of China's evolving foreign reserve management strategy. For years, the nation had quietly diversified its holdings, incrementally increasing allocations to euro-denominated bonds, gold, and alternative assets. The sudden dump of $113 billion, therefore, might be interpreted less as a meltdown of fear and more as a pre-planned recalibration, given added urgency by the trade spat. By choosing to sell U.S. treasuries at a time when global yields were on a general upward trend, China faced losses but sent a potent message. Its actions would no longer be governed solely by market returns, but also by strategic considerations. Moreover, the episode highlighted the delicate balance that central banks must strike between financial returns and monetary policy objectives. The U.S. Federal Reserve, grappling with elevated inflation and the after-effects of pandemic-era stimulus, now had to consider the impact of politically induced volatility in the bond market. In policy circles, discussions began anew about the merits of more aggressive communication strategies and perhaps even direct coordination with the Treasury to mitigate the risks of sudden reserve shifts by foreign holders. For U.S. corporations reliant on low borrowing costs, the implications were immediate. Higher yields translated into more expensive credit, which could dampen investment plans, slow corporate expansion, and potentially weigh on hiring in capital-intensive industries. Conversely, savers benefited from marginally improved returns on safe assets, offering a small silver lining for risk-averse households. The tug-of-war between borrowers and lenders underscored the fundamental role that sovereign debt markets play in transmitting changes in global sentiment to domestic economic conditions. In diplomatic backchannels, the sell-off of treasuries became a focal point for discussions on crisis management and conflict prevention. Both Washington and Beijing recognized that a full-blown financial showdown risked spiraling into broader economic turmoil. As a result, envoys began quietly exploring mechanisms to insulate the U.S. debt market from further politicization, including proposals for joint statements reaffirming mutual commitments and the establishment of emergency consultation protocols to prevent misunderstandings from triggering further sell-offs. China's decision to offload $113 billion of US Treasuries thus represented far more than a financial transaction. It was a carefully calibrated geopolitical act that forced a rethinking of assumptions about economic interdependence. By severing a portion of its financial tether to the United States at precisely the moment when U.S. trade policy took a confrontational turn, Beijing demonstrated that reserve management had become a frontline tool in the arsenal of modern statecraft. The reverberations of this event would shape policy debates in capitals around the world, as nations grappled with the reality that financial markets, once regarded as neutral arenas, could be transformed into battlegrounds in the contest for power and influence. In this new era, the flows of capital were not merely dictated by yields and credit ratings, but were inextricably bound to the imperatives of national strategy and the shifting sands of diplomatic relations. The rapid divestment of $113 billion in U.S. Treasuries by China in response to sweeping tariff announcements did not occur in a vacuum. Rather, it unfolded against a backdrop of evolving Chinese domestic priorities that had quietly rerouted the country's economic trajectory over the previous decade. Beijing's leadership, conscious of slowing growth and rising debt levels at home, had embarked on a gradual transition from an export-led model to a consumption and services-driven one. In this light, the Treasury liquidation served a dual purpose. It delivered a powerful geopolitical message while simultaneously giving China's vast foreign reserves a nudge toward greater flexibility, allowing officials to redeploy capital into assets more closely aligned with long-term domestic objectives. One such objective was the bolstering of China's nascent domestic bond market. Officials had long lamented the country's underdeveloped financial system, which lagged far behind its GDP ranking. By reclaiming a slice of its reserves from U.S. debt, China freed up liquidity that could be used to deepen trading in renminbi-denominated sovereign and corporate bonds. Government planners envisioned a future in which the renminbi would occupy a larger share of international transactions and reserve holdings, a step toward diluting the dollar's dominant status and insulating China from the gyrations of external markets. The recent sell-off, therefore, became a clarion call to domestic investors to embrace government bonds, fostering a more vibrant yield curve and enhancing monetary policy transmission. Simultaneously, the divestment played into wider efforts to accelerate internationalization of the renminbi. China had gradually expanded its network of currency swap lines and offshore clearing hubs, aiming to create a parallel financial ecosystem independent of U.S. institutions. By reducing treasury holdings, Beijing intensified pressure on global market participants to become more comfortable holding and trading Chinese debt instruments. If central banks and asset managers observed that China was less reliant on U.S. paper, they might feel emboldened to similarly diversify their portfolios, though such a shift would require further liberalization of China's capital account and stronger legal protections for foreign investors. Indeed, capital account liberalization featured prominently in Beijing's 5-year economic plans, and the Treasury sell-off added momentum to those initiatives. While Chinese officials hedged against rapid, uncontrolled outflows by retaining tight regulatory controls, they also recognized the strategic importance of offering foreign investors broader access. To that end, authorities quietly moved to streamline Bond Connect programs, expanded quotas under the Qualified Foreign Institutional Investor Scheme, and signaled a willingness to amend tax regulations on overseas holdings. Though these steps would not bear immediate fruit, the recent use of treasuries as a policy lever underscored the growing interplay between China's reserve management and its capital market reforms. Meanwhile, in the United States, the sell-off prompted renewed scrutiny of the treasury market structure. The primary dealer system, long regarded as a bulwark of market stability, came under fire as analysts questioned whether it could withstand episodes of politically motivated supply shocks. Senate hearings were convened to examine the resilience of settlement and clearing operations, explore potential circuit breaker mechanisms, and assess the need for coordinated intervention tools between the Federal Reserve and the Treasury Department. The debate revealed a tension at the heart of U.S. financial governance, preserving the open, freewheeling nature of the Treasury market while safeguarding against strategic disruptions. In parallel, private market participants began to explore innovative hedging instruments. Exotic derivatives that allowed investors to offset the risk of sudden supply surges began to gain traction. These products, which had previously catered to niche demands, saw volumes swell as pension funds and insurers sought to immunize themselves against the possibility of further sovereign-driven supply shocks. While such instruments carried higher costs and complexity, they reflected a broader willingness within the market to pay for protection against policy-induced volatility. As Washington and Beijing sparred through financial channels, the broader architecture of global economic governance felt the tremors. Multilateral institutions, the International Monetary Fund, the World Bank, and the Bank for International Settlements, faced calls to modernize their frameworks to better manage the risks introduced when major economies weaponized their balance sheets. Proposals emerged for enhanced transparency in sovereign reserve management, standardized reporting of large-scale shifting of holdings, and contingency planning exercises involving rapid coordination among central banks. While consensus was hard to achieve, states were loath to cede any strategic ambiguity. The conversation marked an important recognition. The old rules of benign neglect in reserve management no longer applied when states actively sought geopolitical advantage. Within China itself, the selloff energized discussions about the country's long-term economic diplomacy. Overseas, Belt and Road Initiative projects offered a vehicle for recycling dollars into infrastructure investments in Asia, Africa, and Europe. Having scaled back treasury holdings, Beijing could deploy a portion of its reserves directly into development projects that strengthened political ties and opened new markets for Chinese firms. While critics warned of debt traps and geopolitical overreach, Chinese strategists viewed these investments as a natural counterweight to the traditional security partnerships that the United States maintained in the Indo-Pacific region. By redirecting capital flows toward high-visibility projects, from ports in Pakistan to railways in Kenya, China could shape international norms around development finance and cultivate allies less beholden to Western institutions. Another dimension emerged in China's burgeoning digital finance ambitions. The People's Bank of China had been piloting digital currency features that promised to enhance transaction monitoring and exert subtle controls over cross-border flows. Following the Treasury divestment, regulators accelerated trials, both domestically and through bilateral arrangements with partner central banks, to explore how a digital renminbi might facilitate targeted investments or impose selective capital controls in response to geopolitical developments. If successful, such a system could allow Chinese authorities to deploy or restrict funds in near real time, an agility unmatched by traditional sovereign reserve operations. In Washington, corporate boardrooms grew increasingly preoccupied with the prospect that the Treasury sell-off was but a prelude to more frequent use of financial firepower by major powers. Stress tests began to incorporate scenarios where non-market forces triggered sudden reallocation of reserves, and CFOs weighed the strategic risks of over-reliance on dollar funding. Some multinational companies, particularly in technology and energy, accelerated efforts to invoice in euros or renminbi, hedging against both currency risk and the specter of financial weaponization. Supply chain financing agreements were revisited to include clauses addressing sovereign credit risk events, and treasurers sought to deepen relationships with non-US clearing banks. Beyond the boardrooms and finance ministries, the broader public became more attuned to the geopolitical implications of financial plumbing. Media outlets ran explainer pieces on why sovereign debt holdings matter, credit default swaps, and the anatomy of the treasury market. Universities introduced special modules on economic statecraft, blending courses in international relations with fixed income analytics. A new generation of policymakers emerged, fluent in both the quantitative intricacies of capital markets and the strategic calculus of great power competition. The sell-off also sparked philosophical debates among economists and political theorists. Was the episode a sign that economic interdependence was unraveling, or simply an example of states leveraging every tool at their disposal? Some argued that the market stabilized quickly, demonstrating resilience. Others countered that the damage to confidence was less tangible but more profound, eroding trust in the implicit guarantees that had underpinned globalization since World War II. The dispute played out in academic journals, policy think tanks, and op-ed pages as experts weighed whether the era of benign financial cooperation was drawing to a close. In Beijing's strategic calculus, the Treasury sell-off became a case study in crisis signaling. Chinese diplomats analyzed the U.S. administration's responses, noting which officials publicly fretted over bond yields and which sought to downplay the action's significance. By mapping these reactions, Beijing refined its playbook for future episodes, targeting not only the financial levers themselves, but also the channels through which policy elites interpreted and reacted to such moves. The goal was to cultivate a nuanced understanding of adversaries' tolerance thresholds, enabling calibrated escalations without triggering uncontrollable blowback. In parallel, China's financial regulators examined the domestic lessons of the episode. They scrutinized capital flow management tools, such as reserve requirement adjustments, moral suasion, and selective approvals, to ensure that overnight reversals could be executed smoothly if global conditions became too volatile. Stress tests of the banking system incorporated scenarios of sudden outflows from offshore liabilities, and contingency frameworks were bolstered to allow swift interventions in the foreign exchange market. The sell-off underscored the need for a robust toolkit to manage the risks that come with operating in an increasingly politicized financial environment. On the diplomatic front, the dollar Treasury nexus incident prompted back-channel dialogues aimed at establishing financial de-escalation protocols. Officials from the US Treasury, the Federal Reserve, and their Chinese counterparts explored informal understandings, confidence-building measures to reduce the risk of misinterpretation. Proposals included advance notification of large reserve shifts, joint statements affirming commitments to market stability, and even technical guardrails triggered at defined thresholds of Treasury sales. While these talks remained sensitive, states were reluctant to formalize obligations that might constrain strategic autonomy. They signaled an awareness that unmoderated financial hostilities could inflict damage far beyond immediate market gyrations. In Europe and Asia, the sell-off galvanized efforts to diversify reserve portfolios away from an overconcentration in dollar assets. Central banks in Singapore, South Korea, and the Gulf states publicly reaffirmed their commitment to a diversified mix of currencies, including the euro, yen, and, prospectively, the renminbi. Some institutions quietly expanded allocations to sovereign wealth fund partnerships and real assets, viewing them as less susceptible to political machinations. The result was a slow but perceptible shift in the composition of global reserves, a trend that, if sustained, could gradually chip away at the dollar's unchallenged supremacy. At the same time, the events of that spring heightened interest in regional financial safety nets. The Chiang Mai Initiative in Asia, the European Stability Mechanism, and other multilateral facilities gained renewed attention as mechanisms to cushion member states against sudden shifts in global liquidity. Discussions emerged about whether these institutions could offer liquidity lines denominated in multiple currencies, reducing reliance on the IMF and the US Federal Reserve's swap lines. Such regionalization efforts aim to provide a more decentralized buffer against the risks posed when large holders of US debt wield their clout. Even in commodity markets, ripples from the Treasury sell-off were felt. Traders in Brent and WTI crude monitored bond yields closely, recognizing that sustained higher rates would dampen global growth and, by extension, oil demand. In futures trading, increased volatility premia reflected hedging against slower economic activity. Conversely, gold prices saw upward pressure as investors sought safe havens beyond sovereign bonds, viewing bullion as less subject to strategic hoarding or fire sales by nation-states. The interplay among debt yields, currency values, and commodity prices underscored how a single act of sovereign finance could cascade across seemingly disparate markets. In educational circles, the sell-off was codified into case studies on economic coercion. Business schools introduced simulations where students stepped into the roles of finance ministers and central bank governors, negotiating under the threat of reserve-based retaliation. These exercises highlighted the complex trade-offs between economic openness and strategic autonomy. They also fostered a generation of professionals attuned to the reality that in today's multipolar world, capital flows and geopolitical imperatives are two sides of the same coin. For human rights organizations and civil society groups, the incident opened new avenues for advocacy. They argued that financial statecraft could be wielded not only between great powers, but also against smaller states to punish human rights violations or political dissent. The China-US Treasury standoff thus became a cautionary tale. If sovereigns could weaponize reserves against each other, what would prevent them from imposing financial blockades against nations they deemed problematic? The ensuing debate touched on the ethics of economic coercion and the need for international norms to limit such practices. In the technology sector, fintech innovators saw opportunity in building platforms that could offer real-time analytics on sovereign reserve movements. Startups pitched dashboards that combined central bank disclosures, on-chain data, and machine learning forecasts to anticipate when and how large holders might rebalance their portfolios. Institutional investors clambered onto pilot programs, keen to gain an informational edge. The proliferation of these tools promised greater transparency, but also raised concerns about the amplification of market moves if algorithmic trading strategies converged on similar signals. Meanwhile, think tanks in Washington and Shanghai produced white papers dissecting the anatomy of the selloff. Each offered contrasting frames. American analysts often emphasized the threat posed by politicized reserve use, warning of a slippery slope toward financial coercion. Chinese scholars countered that diversification of reserves was a sovereign right, necessary for risk management. Both sides agreed, however, that the episode marked a fundamental shift in the strategic environment, a recognition that economic interdependence could be weaponized in ways previously unimagined. As the immediate market shock of China's sale receded, a broader transformation took shape. The once clear line between economic policy and national security policy blurred further, reshaping the agendas of finance ministries, central banks, and defense establishments alike. Strategic planning cycles in both countries began to incorporate financial market scenarios on par with conventional military exercises. In budget deliberations, allocations for diplomacy and finance ministries received new scrutiny, seen as frontline instruments of statecraft. By the end of that year, the legacy of the $113 billion divestment had crystallized into a set of enduring shifts. Treasury market stakeholders had updated their risk models, corporate treasurers had diversified their funding strategies, and central banks had broadened their reserve mandates. The renminbi had made modest inroads as a reserve currency, bolstered by China's continued push for financial liberalization. Yet the dollar retained its primacy, testament to the depth and liquidity of U.S. markets and the weight of entrenched network effects. Still, the broader lesson was unmistakable. In an era of great power competition, financial reserves were as much a strategic asset as any naval fleet or missile battery. The power to cause or avert market disruptions became a new dimension of influence. And as countries around the world watched the US-China tussle over treasuries, they took stock of their own vulnerabilities and strategies, forever altering the contours of global economic governance. The aftershocks of the event would reverberate for years to come, shaping not just bond yields but the very architecture of international relations. For China, it reaffirmed the potency of reserve management as a strategic lever. For the United States, it underscored the perils of over-reliance on foreign financing and the imperative of bolstering domestic savings. And for the world, it heralded a new era in which the flows of capital were entwined ever more tightly with the currents of geopolitics, where the line between market and state blurred in the contest for advantage. In this unfolding landscape, the $113 billion sale remained a stark reminder that in global affairs, money had become as powerful a weapon as any docked warship or patrolling fighter jet. In the wake of these developments, academic collaborations began to span finance and international affairs departments, producing interdisciplinary research on financial diplomacy as a distinct field of study. Governments established task forces to monitor the intersection of sovereign balance sheets and strategic risk, while private consulting firms launched specialized practices advising clients on geopolitical risk-adjusted asset allocation. Professional certifications emerged for strategic financial analysts, reflecting the demand for expertise at the nexus of economics, diplomacy, and security studies. Meanwhile, media coverage evolved to routinely feature segments on sovereign reserve shifts alongside conventional market news, signifying a paradigm shift in how audiences perceive the interplay between politics and finance. Historical comparisons proliferated, likening modern reserve maneuvers to naval blockades of old, a reminder that control over vital arteries of commerce and credit remained central to power projection. The saga of China's $113 billion treasury divestment crystallized an enduring truth. In an interconnected world, financial instruments are not passive stores of value, but dynamic tools of influence. As nations recalibrate their strategies, the boundaries of economic statecraft will continue to expand, ensuring that reserve management remains a key battleground in global power struggles. If you like this video, please give it a like and subscribe to our channel. Also, could you leave your comments below and tell us? What are your thoughts on China dumping US debt after Trump's tariff announcement? We want to hear from you. Thank you for watching and see you next time.